What it do, fam? It's been a couple of weeks with wavy fluctuations in the market, and while there's been a lot of money to be made by betting on the swings, there's just as much reason to look for places to stash the bulk of your dineros for the long term. Today, we're going to introduce a few options that may provide you with some peace of mind in the midst of these market swings. You're watching Sekider, and this is what we're watching for the week of February 15th to the 19th. Now, this is just a reminder that these videos are meant for educational purposes only and aren't meant to replace legal or financial advice from a paid professional. We're just here trying to help out those who would otherwise be unaware of their options in our local stock market. Also, we'd appreciate it if you could do us a massive solid, scroll down, click the like and subscribe buttons, and maybe drop a line in the comment section to let us know how you're choosing to approach these rocky days in the short term and setting yourself up for the long term. Now let's get to it. Alright, today we're going to feature a quote by Howard Marks, who wrote The Most Important Thing. Specifically, he said that the risk that matters most is the risk of permanent loss. And with that in mind, we're going to go through a few ways to protect yourself from such permanent losses, barring civil war, economic revolution, or any other devastating economic event that would otherwise put your finances onto the back burner. To start, we're going to try to satisfy those who are actually looking for a stock. And since we're thinking safety for this episode, one relatively safe company over the past few years has proven to be Merit's Fire and Marine Insurance, also known as Merit. Now, you may already know about this stock, and the first thing that anybody talks about when thinking about Merit is the fairly high dividend. See, about 5 years ago, they had a yield of 3.5% at 831 per share. Since then, the company has maintained an above 5% dividend yield with a fat 8.5% yield in December of last year, and that'll be paid out this May. Furthermore, the company has a solid history of meeting or exceeding quarterly forecasts going back a few years, while also maintaining sufficient free cash flow to survive unexpected periods of financial difficulty, such as the coronavirus. With a good dividend, a good company, and a PE ratio of 4.8, which is well below the industry average of 11, added to relatively stable prices, it sounds like a good deal, right? But as with anything, there's always a but. Regarding Merit, the biggest but is that of accounting changes that are to be made through the implementation of IFRS 17. Now, this is a change that will essentially change the way that insurance companies in the world conduct their financial accounting and reporting. And if you want to actually know what that means, I'll link an article to how IFRS 17 will affect the financial reporting of these companies. But in short, the aim of this reporting change is to ensure that more transparent, more useful, and ultimately more precise information is provided by the insurers on the value and profitability of their operations, and to create a framework that applies the same rules across different nations, different insurance contracts, and different industries. Now, given that Merit has had 4 years to prepare for the implementation of this change and has a proven management team, one would expect that this change will have little effect on their profitability and ultimately the safety of this stock. But it may be worth a second of your time to look into Merit for its long-term potential and see how IFRS 17 will affect them in the short term. Now let's talk about the most classic low-risk alternative to stocks: bonds. To buy bonds in Korea, you just need to find the Taekwon tab in your brokerage app, which obviously means you need to have a brokerage account to buy them. You'll also probably need a lot of money because, bonds are expensive. Bonds are rich people stuff. But on top of all this, you'll need to do a little more research on bonds, the bond market, and how to actually make money through buying and selling of bonds, as well as their relationship to inflation and interest rates and that type of thing, because they do behave a little bit differently from standard stocks. Alright, now, in that particular realm, you'll also want to know the difference between corporate and government bonds, and also know what's right for you. Or you could just not worry too much about it and simply buy a bond ETF. Now, these funds will do all the buying and selling of bonds for you, and you can simply just buy and hold. The ETFs will fluctuate in price as ETFs do, but at the end of the day, you'll be holding a basket of safe securities which, as long as you don't purchase one that applies leverage, you won't have to think about too much. You'll get paid by your fund directly into your brokerage account the same way that any other security would pay you dividends, and that's about it. Shop around on Naver and choose the ones that you like the most, but the safest way to go about it all would just be to pick an ETF with no leverage and low fees, as well as a consistent record of growth. And for a lot of the bond funds in Korea, the slope will be rather shallow and very stretched out, but it'll still be pretty much constantly up over the course of, a year, 2 years, 3 years, that type of thing. Now, if you're looking to get into the corporate bond market, please make sure you do your research and do as much research as possible into the companies you're looking into, because although bonds are technically debt holdings, there are still scenarios in which you can lose money and the companies will not be able to pay back their debts. So it would be in your best interest to ensure that you protect yourself from a scenario where you would sustain permanent losses through bonds. And finally, the third category we're going to talk about today are commodities. Now, a standard brokerage account will not be enough to trade in commodities futures given the necessity of margin. So the easiest way to trade commodities for a regular ass just trying to buy and not really trying to quit my job type person would be to invest in commodity ETFs. Main thing to pay attention to here is the distinction between either sunmul or shilmul. The former refers to funds that trade in commodities futures, whereas the latter refers to funds that trade in the physical commodity itself. And that's about it. 3 potential vehicles to preserve your money in this market without thinking too much about it. A. Steady and reliable companies with a good dividend and solid free cash flow like Meritwaje. B. Bonds or bond ETFs. Or C. Commodity ETFs. I would also probably mention the concept of defensive picks like government-owned and run companies like KEPCO and IBK. KEPCO has a pretty ridiculous moat given that they're the only legally allowed company to oversee the distribution of electricity across the nation, but they also will be playing a very integral part of the Korean New Deal going forward. Now, if the main goal of preservation of wealth is to avoid the effects of inflation while also avoiding permanent loss, then companies that are majority government owned could very well be the safest companies to invest in. Keep in mind, however, that government-owned companies will always have a cap on how much growth they'll be able to see compared to private companies due to standard government-based factors like centralization of governance, bureaucracy, lack of investor incentives, active unions, and all the stuff that makes companies pretty decent places to work but a little bit less profitable. IBK tends to have particularly high dividends for retail investors, and KEPCO seems to be primed to have a nice little run with their new university opening near Gwangju, as well as their central role in the New Deal, so it might be worth looking into both KEPCO and IBK, but it's probably best to approach them less as growth stocks and more as defensive stocks. Alright, that's enough for me. I hope you had a restful holiday, and I hope that some of your bets have paid off. Really do hope that you learned something here. If you do have any questions, feel free to drop a line in the comment section because, as we have in the past, we're very willing to answer a lot of your questions. In spite of the rocky performance in the market, there have been some pretty good discounts going on, so make sure to do your research and maybe take a good look at the whole market whenever you have the time. Alright, actually going this time. Peace.